Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review on a Monday, and hopefully you're not experiencing the case of the Mondays. And if you don't know where that's from, it's from Office Space, and I'll actually play this clip for you so you know what I'm talking about, just in case you don't know.
Hey guys,
What's up, G?
wanna go to Chachki's? Get some coffee?
Oh, it's a little early.
I gotta get out of here. I think I'm gonna lose it.
Uh-oh. Sounds like somebody's got a case of the Mondays.
uh, does anyone ever say to you, sounds like somebody's got a case of the Mondays?
Let me ask you something. When you come in on Monday and you're not feeling real well, does anyone ever say to you, sounds like someone has a case of the Mondays?
No. No, man. Shit, no, man. I believe you get your ass kicked saying something like that, man.
All right, well, let's get started, and hopefully you won't get your butt kicked for doing velocity banking. But yes, it is Monday, and it's time for another velocity banking review. Okay, so what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And there's only two requirements. Actually, this isn't a goal. Requirements for velocity banking. Number one is a budget. And then number two is you just need a line of credit as your main operating account. So as you can see right here, we've done our budget. Okay, we've done our budget, income, expenses, leftover savings, and then we do an expense breakdown. In our expense breakdown, we list every single debt that we have, right? And then we have our general expenses, food, gas, insurance. Well, not rent in this case. What am I doing? Food, gas, insurance, right? Things we have to pay for. And our whole goal is to make sure all of these go to zero. All of our debt goes to zero, okay? Including the mortgage. And we're going to assume we have the same income and that we also have the same expenses. So one thing that people really get tripped up about is that they're just not going to save money, right? Because if you look on the internet, aka the propaganda machine, right? You asked, should actually, what does that say right there? Hold on. You can find George's Best Burger in a humble gas station. I wonder if they're talking about Buc-ee's, but that's not a humble gas station. All right. So should if I type in should I save money, right? You could see that lots of websites like Bankrate, and I don't know if you know bankrate.com, one of the most popular websites, says 7 top reasons to save your money. But let's just do an investigation. Who funds bankrate.com? Bankrate.com. Independent advertising supported comparison service. So basically, they're supported probably by bank ads, right? Lots of money goes into bankrate.com. Right here, $28.50 per share. Actually, $1.2 billion. Bankrate was acquired by Red Ventures for $1.2 billion. So they're not a ma and pa operation. Right? So top 7 reasons to save your money, and we're just gonna not do that, right? And we're gonna increase this thing called cash flow, and we also need something called line of credit, right? Line of credit. And so let's assume we have access to maybe, I don't know, $110,000 line of credit, and we'll do 10% interest rate, even though I actually have a 7.5% interest rate. So what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. So this is my $280,000 line of credit, meaning I could go to the bank's website, click a button, okay, and then they'll dump up to 280 into my checking account at a 7.5% interest rate, okay, 7.5% interest rate. And yes, yeah, that's my, what am I even talking about? This is my home equity line of credit. And okay, so here's the secret to be able to get lines of credit is that banks don't lend money to people who need it. They don't. And so if you ever try to get lines of credit or any credit in general, even loans, when you're struggling, they will never lend it to you. You have to be aware of that. They will never lend it to you. Banks don't lend money to people who need it, right? So you always got to get the line of credit before you need it. And that's how I have over $594,000 in lines of credit in total. It'll probably be over 600,000 soon. And then we'll get to a million someday. Okay. So let's go ahead and do this. And then we're going to transfer some debt to increase this thing called cash flow. So how much is this? This is 5, 30, 35, 30. Let's see. 35, 30, 35, 33, and I'm going to go ahead and sum this up. So it's $103,000 of credit card debt. So simply by moving this $103,000 of credit card debt, okay, what happens here? Well, guess what? All these credit card payments simply just go to zero. So how did we go from $53 to $3,460.66? Right? If you were in this position, don't you wish that you had a line of credit free and available for you to use, but you don't, or you're probably not going to, because you're thinking, man, I should get a line of credit, and this is the worst time to get a line of credit. Got to have a good foundation. That's what I'm teaching folks. So the moral of the story is don't even get here. Okay. But if you're here and you had a line of credit, man, it would be a lifesaver. So let's go ahead and pay off the $100,000 credit card debt. And then to get the next month's balance, it's the previous month's balance, previous month's interest minus our cash flow, which is 3460.66. So it's going to do this right here, 3460.66, right? And then we take the interest by getting the average daily balance, not the sum, average, multiply it by the interest rate. So times 0.1, and then divide by 12 because the interest is calculated monthly, right? And then what we do is just copy and paste. Let's do it. All right. Let's do it. Copy and paste. Copy and paste. And then we see that in 35 months, it is all paid off. 35 months. All right. 103K. All right. So now we have these 3 loans. Okay. We have these 3 loans. And then this is what we're going to do. We're going to use our loan calculator to figure out what the balance of 3 loans are. So we're at 35 months. So you just type 35, 35, 35. And then how do we figure which loan we're going to move into the line of credit? Do we focus on this highest interest rate, which is very valid? I prefer to use something called the cash flow index, which is the formula of the balance, right? It's the balance divided by the payment amount. And basically, the lower the number, that's the one you want to pay off because it's like, hey, would I want to pay $9,000 to get $386 back of cash flow in my life, or 25 grand for 350? And I definitely don't want to pay the 198 to 1,000. I don't even have the line of credit to fit the 198, but I definitely don't want the 198 to get the 1,000. So let's go ahead and do this in the right order. And let's go ahead and do this. And do plus 9261.98. And then this is 0. $38847.41. Okay. And then you see that in 2 months, it's completely paid off. Okay. And so now this is going to be 0. It's 37, 37. And then 24 grand is the interest. Now, right now, the line of credit interest rate that we're using is about 10%. It's not necessarily a good idea just to move the loan into the line of credit, especially if this cash flow index is relatively high, let's say above 50, and there's an interest rate difference. So the safest way to pay these off is using something called the chunking method, which just means you take a piece of the loan, move it into the line of credit, and then we rinse and repeat over and over again. So let's go ahead and do that right here. So what does the chunking look like in real life? What's our salary right now? So we'll say we'll just move 8,000. So we'll just say plus 8,000, and then move it to the line of credit, right? You still make your monthly payment, but then you just kind of rinse and repeat, and then the 8,000 gets paid off, right? Relatively quickly. Okay. So, all right. So let's go ahead and do this and use the velocity banking calculator to figure out. All right, so I'm going to do this. This is 33 grand, 33,000. Current balance is 24,517. 24,517.46. Payment amount is 350.02. I love how it's just plug and play. And I'm just going to type in the numbers and then it spits out a number for me. So 7,200. And then our expenses is everything except for the loan we're trying to pay off, which is 3,002.57. So 3,002.57. And then let's just do an $8,000 chunk at 10%. And this gets paid off in 0.5 years. Well, actually, is it 5% loan? I think it's a 5% loan. Let me just quickly check. Yeah, 5%, 33,000. So five. All right. So let me just do this. I want to see what the difference between moving the loan and just doing chunking is in this case. Yeah, we pay an extra $100 more. So it's not a big deal when it comes to the student loan, right? I mean, the payoff is relatively the same. If it's more convenient for you, then, go for it. But if you do a small chunk, you'll see that you save $100, which is not really that. I mean, either way is fine because you know, it's just an extra $100. But I just want you to be aware of that. And this is really important, especially when it comes to the 30-year mortgage because of that high cash flow index, right? So let's go ahead and then we're going to move here. So this is going to be 35 plus 6, 41 months. And then this is going to be 103 plus 21. And then this is going to be 124K. And then actually, that's not right. This is, hold on. 103 plus 21 plus 33 is 157K. And then this one, I think was at 37 months. Yeah, 37 months. All right. Wait, yeah, 37 and then plus 6. So what's 37 plus 6 is actually 43. My bad. All right. So now last one is the mortgage. Okay. So 43. And then we just do the same thing. We just type in the details. So it's $2,000 in our expenses. So it's going to be 1,002.57 is the mortgage. 2,000. And then, oh, you know what? I know why I was screwed up. It should be 10 years. But I don't know if that makes that big of a difference. Oh, it's still 0.5. Look at that. All right. What am I doing? All right. I'm totally not awake, but it's okay. So let me just do this again. 1,002.57. And then this is going to be 2,000. And then, all right. So it's 4%. And what's the balance? It's 210. Yeah, 210 is the original balance. And then the current balance is 196,035.75. 196,035.75. 3.4 years. Impressive. But I paid off my mortgage in 2 years and 9 months. So not as impressive as me. Me being declared the self-declared GOAT King, greatest of all time when it comes to debt payoff because I paid off my mortgage in 2 years. So this is almost close, but not as impressive as me. Let me go ahead and feed my ego just a little bit, and you can go ahead and stare at this, right? Paid off mortgage in 2 years and 9 months. All right, so let's go ahead and type in. So it's 3.4 years. We'll do this. So this is 0, and then this is going to be 43 divided by 12 plus 3.4, and then that's going to be 6.98 years. And then we go 157 plus 210, and then that'll be 367K. All right, well, that's it. Is it only 367? It's not that much debt, I guess. Last time it was 746, but then we're dealing with a lot bigger income. But yes, we paid off the debt. Okay, we are debt free. So it looks like no one's gonna have a case in the moon days, and kick your whatever it is that he said. Let me see, play it again.
You get your ass kicked saying something like that, man.
Okay. All right, everybody. Have a great day. and I will see you all in the next video.